We are in Cracker MCQ series BFM module C and D. Up till now we have covered module A, B, C, D of ABM completely, all the MCQs, and module A and B of BFM. Right now we are in module C and D, very important modules. Remember, BFM topic as a whole is important and it's the toughest one. Okay, so let's start. Follow this video till the end. Before going ahead, I would suggest download Adda 24/7 YouTube channel or 24/7 app on your mobile. In this app, you will be getting all the premium study material, current affairs, job alerts, daily quizzes, subject-wise quizzes, magazines, power capsules, notes and articles, videos. What do you need for CAIIB, for clearing CAIIB? Video lectures means live classes, notes and test. All of these are there over here. Okay, so download it immediately. Also join Officers Adda YouTube channels. Subscribe to it now. Why? Because in this channel you will be getting all the updates on CAIIB, and also this series, the similar series, various series going on. You'll get it on this channel only. Okay, this new offer is going on for 80% off plus double validity on all the Maha packs. I'll come on this later. Use the code Y432. Okay, yesterday I had asked you one question for homework. The question was, what is the reinvestment risk? Okay, so reinvestment means what? What do you understand by this word reinvestment? Whenever I have to invest, I have invested anything and I have to then withdraw it and again reinvest it. That's basically reinvestment, isn't it? If you have an FD in your bank, if that FD matures, again if you want to this reinvest that FD, then whether you'll get the same rate of interest is the reinvestment risk, isn't it? So let's look at the options. When interest rate at which the future cash flows can be reinvested are uncertain, it is called as reinvestment risk. Correct? Means when I have to reinvest the same amount and if the rate of interest are uncertain, definitely it's a reinvestment risk. Any mismatch in cash flows will expose the bank, right? So mismatch in cash flows means what? If your rate of interest falls down, definitely there will be a mismatch in the cash flows of the bank. So it will expose the bank to what? It will expose the bank to liquidity risk, right? Since the market interest rates move in different directions, it will have variation in net interest income. So if the market interest rates move in opposite direction, different means here they mean opposite, okay? Opposite to your favorable situation, then definitely you will be having this NII problem, okay? So all these features are correct on this. So the correct answer is D, all of these. Got it? Now from next one, I want the answer from your side. I won't be giving the answer because that was a homework question. That's why I gave you the answer. So this, the features of net interest position risk are. Now what is this net interest position risk? See here, it's very simple. In net interest position means basically you mean it as interest rate risk. Similar to that, almost 90% on the same lines. Interest rate risk. Okay, so interest rate risk will give you the interest position. So what are the features of that? Okay, now remember, I want the answer from your side. First everyone read this and get the answer. Okay, in the meantime I'll read this. When there are more earning assets than paying liabilities, interest rate may arise if the market rates adjust downwards, right? Means if your assets are more and your liabilities are less, and if the interest rate goes down, then you will be affected. That is the basic meaning of this. Is this correct? Means assets are more. Let's say I'll give you an example over here. If I have assets of, let's say, 100 rupees and liabilities, here I'll write it assets, okay, and here I'm getting liabilities of, let's say, 70 rupees. Okay, now these are liabilities, mean deposits. Here I have to give the interest, here I am getting the interest, right? So this is positive for me, plus, and this is minus for me. And let's assume the rate of interest for both are same only, let's say 10%. Okay, here 10% incoming, 10% outgoing. Okay, imagine that. Now what is the interest which is coming to me? 10% on 100, so 10 rupees. 10% on 70, so 7 rupees. 7 rupees is going out, 10 rupees is coming in. Now what happens? This interest rate of 10% goes down here. If adjusts downwards, now this 10% becomes, let's say, 5%. Okay, let's take extreme situation. 5%. So 5% on 100. So how much will I get now? 5% on rupees 100, 5 rupees. And now again 5% over here, 5% on this 70 rupees. So 3.5 rupees. Now look at the situation. Earlier I was getting 10, sending 7. So 3 was my plus, I was plus 3. Here I am getting 5, sending 3. So I am plus 1.5 only. So what is the point over here? I have gone down. So if the assets are more, liabilities are less, and the interest rate goes down, you are affected negatively. So that's the point. A is a correct feature of this net interest position, correct? It may result in reduction of net interest income. See this same logic. Net interest income has been reduced. Earlier it was 3 rupees, now it is 1.5 rupees. So B is also correct. C, it will have an impact on the economic value of the bank's assets. What do you mean by this economic value? What is this economic value? Economic value means the value at which the people or the customer are ready to buy your assets. Means your loans, and if you are having some bonds, holding some bonds, so they are ready to buy those bonds again. Okay, so that is meant by economic value of the assets. So it will definitely impact it. So C is also the correct answer. So the correct answer is what? Okay, I gave the answer. I told you I'll be asking. Yeah, but many of you have typed it correctly over here. Others, kindly type it. What do you feel? It should be A, B, C or D. What should be the correct answer? Correct answer is yes, D. Okay, all of these. Next one. Now this is the typical one. This one you will have to give the answer. What are not the features of price risk? Not. Remember, we want not. Okay. Okay. When the assets are sold after the maturities, it may result in price risk. I won't give the answer now. The price risk is closely associated with bank's trading volume. Bank may create such trading investments out of short-term movements in interest rates and all of the above. Now give me the answer, then I'll explain it. First give me the answer. I'll give you 5 seconds. Yeah? What is the answer? Correct. All of these, all majority amongst you have typed this, all of these. Okay, all of the above. Remember, we have a habit of whenever we see such thing as all of the above or none of the above, only B and C, we have a habit of taking that only. But remember, CAIIB is not about that. Here, all of the above is not the answer. So what are not the features of price risk? Okay, I'll just read first sentence, first one, and then you'll understand. When assets are sold after their maturity, it may result in price risk. It will not result. After your maturity means what? Suppose if I am holding one bond which is maturing in let's say December, okay, maturing in December. I hold that bond even after December for the next year up to March, and then I go to sell it. So it's an operational risk on my part. It's an operational fallacy or an operational fault on my part, right? Because if some bond is maturing in December, it should be sold in December itself. So it's not a price risk, it's an operation risk. So this is not a feature of price risk. Got it, everyone? Remaining things are the features. Price risk is closely associated with bank's trading book. Obviously, bank has two books. One is banking book, second is trading book. Correct? Banking book price risk is not affected. Trading book price risk is always affected because M2M is adjusted over here. M2M means what? Mark to market. Okay, that is always a feature of a trading book. Okay, bank may create such trading investments out of short-term movements in the interest rates. That's obvious. Banks may create such trading investments means what? This is basically the feature of trading book of any bank. Trading book means what? Here, I purchase the bonds for two purposes. In the banking book, when I purchase it for CRR and SLR, for keeping them up to maturity. But in trading book, I don't keep them up to maturity. I purchase them for selling. It's a profit generating instrument for me. Okay, so that's why that is the meaning of this sentence. Banks may create such trading investments out of short-term movements in the interest rate. Okay, so the correct answer is A. Got it, everyone? Next one. Which of the following statement is not correct? Okay, we want not correct now. The bond prices and yields are directly related. Is it not correct or correct? Bond prices and yields are directly related. Is it related? True or false? This is false. Correct? Why? because the prices and yields are inversely related. JAIIB theorem number 4, right? Bond theorem number 4, JAIIB. Okay. So even I've taken this in my paid classes also over here. So kindly follow those paid classes. I always suggest. See here the time is limited. In paid classes we have ample time. I explain you all the terms over there. Okay. So the bond prices and yields are directly related. Second, that is false. In fact, you have got the answer here itself. Market price may apply to the pricing risk of the assets held in the trading book. So that is a true statement, because just now I told you M2M is for whom? For trading book only, not for the banking book. So this is true. What do we want? We want a false answer. Okay, so A is the correct answer over here. Now, yeah, there's no point in seeing the remaining ones, but for your information, I'll just give you. The market risk may apply to foreign currency risk. Obviously, foreign currency risk means the rate of change of the dollar or whichever currency it is. So definitely that's a part of market risk. Okay, got it? What is not a forex risk? Remember, not a forex risk. Okay, a risk may arise due to favorable exchange rate movements is called forex risk. Now, is this a correct answer? Okay, I won't give the answer now. First, you have to answer. Let me check how many of you can answer. Not a forex risk. Risk may arise due to the favorable exchange rate movement in the forex risk. Okay, this occurs on account of open position in spot or forward contracts. It is applicable to an individual foreign currency. So which of these? And all of these. D can also be the answer. So what do you think should be the answer? A, B, C or D? Type fast. We want not a forex risk. Okay, what do you think? A, B, C or D? Yes, the correct answer is, yes, many of you are typing D, 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 D. Again, all of these, you have fallen prey to this. Okay, no, the correct answer is A. A risk may arise due to favorable exchange risk. Now, what do you mean by favorable? If the rates go in my favor, then I am earning something bigger, right? So, is this a risk? If I am earning something bigger, it's not a risk. Risk is what? Risk is when the rates move in the opposite direction of mine, right? So that is not a forex risk. This is a, so which of them is not a forex risk? A is not a forex risk. Okay, it's a favorable position. Remaining two things are a forex risk. Means what? Due to open account position. What is open account? Whatever you have at the EOD position, end of the day position. Okay, in spot or forward contracts, and it is applicable to individual foreign currencies. Here it's applicable to each and every individual foreign currency as well as in the portfolio. If you are having the portfolio of foreign currencies, then it will be applicable to all the portfolio, and if you are holding only single currency, then it is applicable to single currency. Logic clear? Okay. Okay, firstly, if you have liked this video, kindly strike like on this, click like on this, share it in your social media, share it with your friends. Let them get this knowledge. It's freely available, right? And also join these classes. Okay, whichever will be coming in. I'll come to this later. Okay, now this is the homework for you. A counterparty risk is, okay, I can answer it now also. Many of you know this answer now also, but those who don't know, kindly try it at your home. A counterparty risk is, it arises due to non-performance of trading partners when the counterparty may refuse to perform. I won't give the answer now. It is treated as a transient financial risk. It is more associated with trading and all of these. Answer is very simple, but I'll give it later, tomorrow. Okay, not now. Okay, before going, this 80% off scheme is going on, double validity scheme is going on all the Mahapacks, and use this code Y432. Now how to use it, I'll show you live over here. Say this, go to Adda 24/7. One sec, let me go to Adda 24/7 live over here. Okay, say this, go to Adda 24/7. Once you go there, click on JAIIB and CAIIB. Once you click this, click on this, see this JAIIB CAIIB Mahapack. In Mahapack, you'll get all the JAIIB CAIIB Mahapack, JAIIB Mahapack, CAIIB Mahapack. Click on this CAIIB Mahapack. If you are for CAIIB, go for CAIIB only. Okay. Read this. 4+ batches of ABM, 3+ batches of BFM, 3+ batches of retail. Case studies are there. 500+ hours are there. You can read it at your at ease. Okay. 15 full-length mock tests. Okay. CAIIB lecture wise PDF, these are also available, and you can go on reading. And importantly, let's come to the fees part, because money is important, isn't it? 32,999. You'll say, sir, very huge fees. Click on this, view offers. Now put the code Y432. Okay, now click on apply. Now what is this? 32,999 has reduced to 6599, 80% off plus double validity of 6 plus 6 months. Now this is a great offer. Okay, double validity, why is it important? Because here this December you will be having the old portion, and next May you will be having the new portion, right? So even if you can't clear this exam within this December, next time whenever you go, you'll get freely these classes. Okay, so go for it immediately. Okay, click on continue and get it. Now why am I focusing on this December exam? See here, I'll tell you one important part about the May 23 exam. I'll give you the portion part over here. Okay, look at this portion. Say this. Presently you are having paper 1 and paper 2, this ABM BFM, right? In May 23 you will be having ABM BFM, Advanced Bank Business and Financial Management, so ABFM, and banking regulations and business laws. Now look at these. These are two separate new topics, and this is related to more to business, not to banking. Okay. What are the topics in this? Management process, advanced concepts of financial management, valuations, mergers and acquisitions, emerging business solutions. So this is more related to business. Okay. And this is related to legal. Now see here, this portion is also the best, means it will teach you more about this finance and whatever is going on in the business world. It's good. I always suggest changes in any portion, but the point is, if you want to clear CAIIB, why to go for unnecessary 2 more subjects? Clear it within these 2 only, isn't it? Also the electives are rural, HR, IT, central banking and risk. It's a favorable one, because here now you are having only elective as retail. Many of you choose retail only, but in future you can have these 5 electives, and these are the specialization courses. It's a good one. Okay, so I would always suggest, although the portion is good, it's a good knowledgeable portion, but I would suggest, why to waste your time and first clear CAIIB. Okay, and then if you want to study, you can study this separately, isn't it? So clear it in December itself. There's a negative marking in May 23. Okay, so I'll be back again tomorrow with another series. Okay, till then, bye.